What's up, everyone? Welcome back to the Outlier podcast. We have a familiar face, David Hunter, and he is going to tell us everything that's about to happen with perfect accuracy. Everything will go perfect, and it'll be a smooth sailing year, I'm sure. Is that about right?
Yeah, that's about right. Market's going to go up and then it's going to go down.
Yeah, honestly, it's a good call. That's probably about right.
Not
So,
sure which comes first, but
or how far it'll go. Yeah, it's just kind of a flip of a coin, eh? Um, No, it's great to touch base with you again. We keep track about every quarter or so just to stay, abreast on what's going on. And it's a chance for us to apply what I always refer to as like Bayesian analysis, right? We do our best analysis based on everything we know at a point in time, and then there's new information that comes out. So then you have to update your analysis. And this is just a process that happens with really intricate systems. So I want to start with, we're about halfway through the year. How has the first half of the year gone so far against your expectations? Is this seeing what you thought you might see, or were there some surprises?
yeah, well, certainly the Liberation Day was a surprise, and we had the 20% hit to the S&P as a result of that. I certainly didn't see that coming. I was calling for a pullback of maybe 5 to 6, 7%, but we went down 20, and Nasdaq went down more. But other than that, really, the year so far is playing out pretty much as expected. I've been the only one out there looking for the kind of levels I'm looking for, and it's moving in my direction. As you know, since 2022, since the bottom in 2022, most of Wall Street has been fighting this thing. They've moved their targets up as the market's moved up, but they've been pretty much 1 foot out the door all the way up. And skeptical said valuations were high 2 years ago, and they're only higher now. So I think the majority of strategists out there have kind of been carried along here, kicking and screaming, whereas I've been, from the beginning, saying melt up, and it's going to go a lot higher than anybody expects. And I raised targets again. So it's as much as I was way higher than anybody else on the street already, I'm that much more extreme now.
Now, when something like tariffs comes out, how does that feed into your melt up and then global bust thesis? Because I could see you approaching it a bunch of different ways, but it's definitely a disrupting factor. There's no doubt. It's a very, very significant impact. So how does that factor into your analysis?
Well, of course, I'm a contrarian, and sentiment plays a big role in my work. So, going back to April, when that came out, the initial reaction was so severe. People got so negative. They were saying the top's in, bear market, going a lot lower. We're going below 4,000. We're going below 3,000. There were a lot of calls out there that were very negative. And that helped me a lot because sentiment is one of my kind of driving elements. And I could, back in the middle of April, it was clear that you were at rock bottom sentiment. You were down 20% in the S&P, but sentiment was equal to what it was almost back in 2020. So I got very bullish then. I think I had a 7,500 target on the S&P going into Liberation Day. When that happened, right near the bottom, below 5,000, I raised my target to 8,000. Raised my target on the Nasdaq, I think, from 23 to 27,000. So clearly that was based as much on sentiment as anything, because the wall of worry got so big. I said we now have fuel for an even bigger advance. And that's playing out. Obviously, we had this huge rebound off of that back to new highs. And then in my recent letter that came out early in July, I raised my target on the S&P to 8,700 and my NASDAQ target to 30,000. My Dow target went from 55,000 to 60,000, and I bumped my Russell target from 3,300 to 3,400. So again, everything's proceeding. As you say, you get new information, you adjust to it. I try to, I don't raise targets because I'm getting close to my targets. I raise targets when my analysis says there's even more upside than you thought. So that's really what drove this.
One of the questions specifically about the indices I have, how do you view the potential price performance in your analysis of something like small caps against Nasdaq, maybe more tech heavy, or S&P, pick your choice? I mean, S&P is tech heavy now too, realistically. They've become like the same thing. But how do you view small caps against either of those buckets in terms of just overall behavior?
Right now, if you did the numbers, you'd find I am expecting the Russell to outperform into the top. And it's based basically on the fact that it's lagged so much. And most people still have the view that it's going to lag right through this cycle. So again, using sentiment, it's, you've already got it pretty well oversold. Um, and I do think as we move through here, you are going to see the dollars coming down. And I think you're going to see interest rates coming down. Interest rates really will help the small caps disproportionately more than the other indexes. So it'll help all of them, but I think it'll help small caps even more.
Beginning of the year, the market was expecting quite a few cuts. I don't remember exactly the number, but I want to say it was what, like 4 to 6, something like that. At the beginning of the year is quite a few. And now the market is obviously slowly accounting less and less and less and less and less. What do you make of that?
Yeah, well, it's obviously part of it's Fed and what Powell said at his various meetings this year. It's pretty clear they're not anxious to cut. Um, it's also the reaction in the bond market. People got spooked. The bond market had started to roll over earlier in the year, got down below 4%, and then right back up to 460. And that spooked everybody. And you had people calling for higher numbers. So the traders just, stopped expecting more cuts. As they got more bearish about bonds, they got more bearish about the anticipation that the Fed will cut. As I've said many times, my bond market call is not necessarily dependent on the Fed. The bond market will move and the Fed will follow. So rates will come down with or without the Fed cutting. The Fed will ultimately respond to the fact that the rates are far away from where the market is. So but I'm not looking, there's a lot of people in the bond market and certainly a lot of retail investors that think you need the Fed to cut to get rates to go down. And that's just not the case. The bond market will lead.
I want to build off that exact point actually, because it was funny earlier in the year. We had a fan favorite term that resurged, which is bond vigilantes. And it was kind of fun to see that come back in because a lot of people aren't even, well, newer traders, I would say, aren't even familiar with like what that is and how that ties into what you're saying. So could you expand on that a little bit about what some of the mechanics can, not necessarily will, but can look like when the bond market kind of dictates where rate is going versus somebody like Powell? Because most people think it's when Powell comes out and says, we're going to lower quarter point. That's when rates go down. But obviously, as you're pointing out, it's just not the case necessarily. So
yeah, let's start with the fact that the Fed controls one rate, the overnight bank lending rate, the Fed fund rate. They don't control the bond market. They don't control T-bill rates. They only control the Fed fund rate. When they set a rate, what that rate they're setting is a rate that's charged between banks. And they can obviously change the discount rate, which is the rate the Fed charges for banks to lend at the open market window. But other than that, the Fed is not in charge of rates. When we hear the term bond vigilante, I tend, and I grew up with that. I mean, it was in the early '80s that came about, and I had forgotten who started using that term, but I'd seen on CNBC recently, Ed Yardeni, I think, was maybe the first to do that. So, in his work when he was an economist, so credit to Ed. But bond vigilante simply means the market participants, the bond market investor, particularly the institutional bond trader or bond investor, when they in the aggregate make a decision on rates by their activity in buying or selling bonds, it moves the market. So it's really supply and demand in the bond market based on bond traders' perceptions of what is going on. So if the bond traders are bullish on bonds and are putting more money into bonds, or they want to lengthen their portfolio and extend duration, you're going to see rates come down. And it can happen when the Fed's sitting on the sideline doing nothing. And it can actually happen more of the other in the reverse. But we saw last fall, the Fed cut rates 50 basis points at the September meeting. And in the next couple months to follow, the bond market sold off. Rates went up, not down. So that should show you more than anything that the Fed is not in charge. They obviously cut rates, hoping to push rates lower, and instead the bond market had other ideas. They were part of it was after September. I think we saw a bump up in inflation, maybe, and a bump up in some of the economic numbers. And so people said, "Oh, the Fed prematurely cut," and bond investors sold bonds. So it really is a day by day, just like in the stock market. You have buyers and sellers, and whoever's kind of got the stronger impetus to do their thing is going to move rates. If they're if there are not more buyers necessarily, because there's always a buyer and seller there, but if there's more inclination from institutions to accumulate bonds or extend duration, you're going to see rates come down. If they're tending to get more defensive, you're going to see rates go up. And that's a day by day thing, but basically the trend is what's important to me. And I can tell you, stepping back, and if people did this, I think they do themselves a favor. Get a bigger perspective of the bond market. If you take a long perspective, whether that's 10 or 20-year bond chart or a 5-year bond chart, step back, you will see we had bonds bottom out in 2020. That I'll use the 10-year. 10-year bottomed out at 0.4%. It then proceeded to run up to 5% between 2020 and late 23. So in 2023, we had a 5% top in the 10-year. From there, we've come off that. We went down below 4% over the ensuing 12 or 18 months. And then we backed up to 460, 470. And now we're just kind of in a trading range between, say, 460 and 430 or 420. If you step back and look at that whole move from the top in rates at 5% in November 23, this is all a top formation. We're building a big top. So you had that big rundown in rates in 2020 and 21, or more down to the low in 2020, and then you rose pretty sharply from almost zero back up to 5%. Now we've spent 2 years basically building a top in rates. And once this breaks to the downside, which is basically a little below 4%, I think it's Katie by the door. Down you go. So that's why my forecast is that we'll see sub 3% this year, and maybe even down as low as 2.5%. Doesn't have to happen, as I say. Markets don't care about the calendar, so if it happened in November or December or happened in January, it's all I don't really care. But it's coming, and I think from there, when the economy really weakens into what I call global bust next year, rates will fall another. They could go down to say 2.5, 3, and then bounce back a 0.5% before they roll over again. But that next rollover after you back up, I think you're going to go all the way down to zero in the 10-year. So you'll be back. You'll be back to the early 2020 rate. The 40 basis points. Probably make a new low below that in the bust, and that'll mark the bottom of the big cycle. That'll be the end of the secular bull market in bonds that started back in 1981.
Now, zooming out a little bit before we get to zooming in on the bus side of things, as always, I'm interested in catalysts. So when you're moving your target up on the indices, for example, we'll start there. When you're moving your target up on the indices, I assume that there's different data points you're collecting that essentially are telling you, like, I actually am more bullish than I was before. What are some of those data points that you're looking at that are leading you to, slowly revise up and see more potential upside before the bust?
Yeah, so it's as I say, I don't do analysis like a lot of, like the CNBC would lead you to believe, where it's, gee, what's the job number this month, and what's the CPI going to be tomorrow, or that's not what drives my work. I look at all that stuff from a trend standpoint. Any particular data point, so the monthly numbers don't move my work, because it's really connecting the dots and looking at the overall trends that are important to me. As I say, in a more general basis, what drives my work is technical analysis, fundamental analysis, macro analysis, um, sector analysis, basically, or what I call cross market analysis, looking at, it might be sectors of the market, it might be other markets like the bond market, the currency markets, foreign markets, whatever. But it's cross markets, see if they confirm what I'm seeing elsewhere. And then sentiment is kind of the overlying driving thing, that if that fits into the whole scheme. And that's when I get all of those different pieces moving in the same direction, confirming my same view, that's when my convictions go up.
I see.
So right now, what I think is the catalyst, or what is going to help drive this final run to the top, which I think happens in the next, could be 3 4 months. Might take longer. I don't know, but it has a potential to happen very fast here. I think we're going to go very vertical very fast after we'll probably have one more run this week or in the next several days. It could spill in next week um, into say, I use a number, but it's not, doesn't have to be this number, but let's say up to 6,500 on the S&P, another 3 4 5% up, let's say, more like 3 or 4%, I think. But um, and then I think we get a pullback. So many people have gotten caught in the momentum now that we probably do need a pullback. I just don't think it comes right from here. People saw the semis are rolling over today, and so, some of the former tech leaders are rolling over today. So I think people are thinking, okay, maybe it's time for that pullback. More likely, I think we reassert the upside here this week, and then we'll pull back from a higher level. Doesn't have to follow that, but that's kind of what I see in shorter term, kind of what I see versus where the consensus is. And then once we have that pullback, which might be, I think we'll go back to the breakout point on the S&P. So that's, say 6,000 to 6,100 in there. I think there may be a gap down there somewhere to fill in. Um, but from there, so that would be, if you're 6,500, you go back to 6,000. You're talking about, say, or 6,100. You're talking about probably 6% pullback, something like that. And in the Nasdaq, probably more than that. So maybe 7 or 8 or 9. And that will get people back on the sidelines, back saying, "Oh, the top's in. Oh, this thing's, there's a lot of risk downside, etc." Sentiment will rebuild. You'll rebuild that wall of worry by having that pullback, and that'll set the stage for what I think is the final run to the top. And I think it will go vertical in that final run. So, let's say the pullback lasts 2 or 3 weeks. Could last longer, I don't know, but let's say 2 or 3 weeks, and then you have the final parabolic run. It might go from 6,100, let's say, to 8,700, which is, more than 40%, it might get there in 3 months' time. I mean, that's a hell of a run, 40% in 3 months. Or it might take longer, but I don't think it'll take a very much longer. So that's why I say 3 to 6 months, but I'm really thinking it'll be shorter than six, more like three.
How do you identify your top targets? So when you're deciding where, and again, is you're identifying here, you're not saying, pinpoint it's going to be this, right? You're obviously saying somewhere around this
Yeah,
spot.
some of it is from a bottoms up. What can the market handle in terms of price?
Okay.
Some of it is, what do I see in terms of what does the next several months look like, and where are investors positioned today? And I don't mean in any scientific way, but kind of gut feel. Where are investors positioned today versus what's going to happen if this thing gets momentum? And right now, we have institutions on the sidelines. I mean, we have a lot. On the sidelines doesn't mean they're in cash. It may mean they're very defensively positioned, in more defensive areas, or, in bonds or what have you. But they're basically not expecting a lot of upside from here. I heard one analyst today, and the interviewer was saying, well, you still look like you're bullish into the end of the year based on your target. How do you, because she was talking about a correction right now, beginning now. And but her target was 6250. We're at 6300 now. So, it's basically a flat from here. Obviously, she's looking for a pullback, and he was, I guess, asking a question from that basis. But still, I mean, that's people. He was talking as if that was an aggressive call for the end of the year, and yet we've already been there, right? I think you've got 40%, and in the Russell's case, 50% upside from here. Um, so, so anyway, sentiment, in my opinion, both on the buy and sell side right now, is pretty subdued. Obviously we've had a lot of momentum, so the sell side strategists are still going with the flow, but they're nervously so, or cautiously so. They're not raising their numbers that might be 64 or 500. They're not all of a sudden saying 7,000. A couple of them might, but not many. So that tells me sentiment's pretty subdued, and more importantly, on the buy side, the actual people buying the stocks, institutions are pretty. I think Bank of America's survey recently showed they're pretty cautious, very cautious, in fact. So that tells me there's a long runway, because this thing doesn't top out until they're all in. Generally, you're going to want to see most of that caution turned into ebullience. The people are going to be, the story that's going to be out there at the top, and I've said this before, is going to be the Fed's now easing. We've got wind at our back, and the easing cycle is just starting, so we've got at least 2 or 3 years to run. That's going to be the narrative. Whereas I'm going to be saying, we discounted all of that. We're at the top. Sentiment is now very bullish. It's time to start taking your chips off the table. So sentiment's a big part of it. How do I determine targets? I don't have a magic formula. Um, some of it is looking at charts and trying to gauge, but as I said, some of it is trying to gauge what is the buying power, what can, how much can things be driven by the fact that so many investors are not positioned for what's coming. And I do the same thing on the downside. If everybody's bullish, there's a lot of room for a lot of selling, and I'll be talking about the downside. But there's no magic to it. You're right. If I get within a few hundred points of it, I'm doing pretty well. This is a 43-year secular top. I'm not pretending to be able. I don't have any. I jokingly say I refer to my Ouija board to determine it, but I don't have any proprietary formula that gets there. I have people that direct message me and say, "Can you give me I'd like to learn exactly how you get your target so I can do that." Right? No, I don't. I don't. I can give you a formula, but I don't have any. um,
As a random offshoot, you are highly interactive with your audience. What's an example of like a really good question somebody has asked you? Because I know it's easy to find a lot of silly ones. So I'm
yeah.
curious. I'm curious about like a good one.
Um, You stumped me. I'll think about that because I don't really think in those terms. So
Sure.
I just kind of answer as they come along, and sometimes I give them a flippant answer because the question was kind of stupid, and sometimes I mean, there are a lot of people asking very
Yeah,
legitimate, sincere questions, but then you get the ones that drive me up a wall. It's easier for me to talk about
I
that than
know.
the other.
It's
The ones that drive me up a wall are the ones that, last week asked me, what do you think's going to happen? I'll give them a scenario about, yeah, I think we probably go higher and then correct. And a week later, they'll come back and say, do you still think it's going higher before we correct? Like and I don't know if I've said it 100,000 times. That's not what I do. I do create some of it myself because I do, throw out scenarios, but
yeah.
I try to get them to understand the difference between a market call, a cycle call, a big picture call, and a scenario. A scenario means it might prove true, but there's six other scenarios that might prove true too. This might be the one that I think is most likely, but it's not a forecast, and I'll get a 2 weeks later, I'll get somebody saying, well, do you still expect this step? I said, well, I never said I expected it. I'm just saying it's what I thought was most likely. But, it's hard to get. You're dealing with such a cross section
Right.
of different levels of understanding of markets. So, and I understand that. I mean, it's not their fault, but it does drive me up a wall sometimes because they all want to go to which you probably would enjoy, but they all want to go to the trading side, the very short term side of things. And I'm trying to push them out into looking at bigger picture, and then I create my own problem because I will talk about the short term sometimes.
Yeah, the reason why I think about that sometimes for my own audience as well, because sometimes they'll ask stuff that actually makes me think about things slightly differently. Because I mean, obviously you've been in markets way longer than I have, but I've been trading for over 18 years now. So there's a lot of stuff that like just becomes kind of intuition, right? You just kind of know, know in quotes the spirit of something, whereas sometimes I'll realize like, oh yeah, like they might not actually see that attachment that like I'm automatically connecting in my brain. So I try to like hone in on those once in a while when I'm looking at different questions. And I knew with your audience you would be getting bombarded with the timing stuff that I'm sure would get pretty fatiguing after a while. But
I mean, I get bothered. I show that I get kind of with my responses sometimes get annoyed by them. But on the other hand, I get where I've
of
I've
course,
had I've had a good record of calling a lot of these things of late. So I get where they're coming from. I just I create my own monster because it's
yeah.
like that's not where my skill set is. Don't if I get lucky and I call something, don't assume that the next time I'm gonna get it right too.
Right, right. Yeah. Now, before you had mentioned doing some sort of sector level analysis, I'm curious, just with a current state, are there any sectors that look interesting to you for some reason, or whether bullish or bearish, good or bad? Even if it's not necessarily a price direction, but just like a technology that you think is cool, anything like that?
Sure. I mean, no doubt the semis, although they sold off today, they're still the leaders, and they'll be the leaders right into the top. So I was never one of those that jumped off the Nvidia bandwagon. I was never one of those that jumped off the Micron bandwagon like people are right now. It's semis are the kind of the backbone of technology, and they will play right into the top here. So they'll have their corrections because they have their nice big moves, and then they have sharp corrections. But that certainly is one of the big leaders. I think financials are very interesting here because they're up near their highs, but they haven't been gangbusters. When I look at the charts, they have a lot of upside, and particularly the broker dealers. Um, it's funny because I gotta remember what it was, but I had a target for XBD, which is the broker dealer ETF. I think I had a target of 1,200, and for a good amount of time. And I looked at it in my last letter and I said, there's no way. That's way too conservative. So I raised it to 1,500. If we're going to 8,700 on the S&P and 30,000 on the NASDAQ, the broker dealer is going to have a lot of upside. So, there's one where I don't know where it is today, but there's a lot of upside there.
Within financials, I've kind of found their recent strength noteworthy because in terms of year-to-date performance right now, I'm looking, it looks like they're number 5 in
Yep.
S&Ps specifically. There's industrials, utilities, IT, comm services, then financials, which are up 8.9% year to date. This is from bar chart, so it might be off a little bit, depending on when they take their snapshot. But within that, insurance has been performing pretty poorly. They're the laggard of the group with like sub 2% year to date, where commercial banks, capital markets, and consumer finance all up double digits.
Yeah, I think
Any
insurance may have had a run before that, so it depends
okay.
on the time you use. But yeah, I think the banks look great, and both both the money centers and the regionals. I think because people have kind of shied away from regionals because of the real estate, the
Right.
commercial real estate store, et cetera. But I think both of those look very good, and some of them have investment banks within them. Certainly Bank of America with Merrill Lynch that I think only enhances the returns that are going to come here. So I think there's the financial when financials are going, it's usually good for the market, and I think that's going to come. Some of that is because don't forget, financials are big bondholders. Banks own a lot of bonds, insurance own a lot of bonds. Um, I do expect. I think we've started to move down in rates. Like I said, there's a big top in rates and it's very close to rolling over. Once it rolls over, I think you're going to see a lot of drop in rates. You're probably not going to get a rate cut next week. I just don't play that game, so they could surprise us with one. I thought there was, a month ago. I said, yeah, you could very well see one in July. Now we're, less than a week away or a week away. The odds are, you know, Powell's going to probably continue to fight Trump on that. But I don't think he wants to cave just to be, pressured into it. And basically they have their rationale. I don't agree with it, but they have their rationale about worrying about inflation from tariffs and still thinking, we have to wait. But the bigger issue, I think, is as you wait, you're going to find there is an impact on the economy. The economy is softening and it's going to get softer going forward. I would think you'd want to head that off, start your rate cut sooner, not later. But I think whether they cut in July or cut in September, I think a rate cut is coming, and then more after that. But as I say, the bond market's moving before that. We're already seeing it. The rates are, down to 430 and change. And I think you're going to see it in the 420s pretty quick. Um, so I think that's that's certainly going to help financials. It's going to help the stock market. It's going to help growth stocks like tech. So I think rates are a big story here. By the way, the dollar um, is right down. I haven't heard anybody talk about this. you go back and draw a trend line from 2011 to now. The dollar's right down on that uptrend line from 2011. That's a big trend line. I mean, it's 14-year trend line. Um, if it ran, I mean, right down on it as of today, I think. You break that, and I think you have a pretty quick run down to 90, probably something like that. So quick meaning next month or two or three. Um, and then my target's 82 on the dollar on DXY. So there's more downside from there. But that's, I mean, that again, I think we'll certainly think about in earnings, currency translation. The strong dollar was taking its toll. The currency translation effect of a weaker dollar is a bonus. That should hold earnings up. So even if the economy is weakening, you have a bullish event from a weak dollar. It also makes us more competitive, obviously, worldwide in exporting our goods. And you have a lower interest rate because, and the other thing that I think is going to help in interest rates is it looks to me like oil is just beginning to roll back over. So we went down to 55 in oil, bounced back to whatever it got up to during the Iran thing, and 75 or whatever, and it's rolling over again, or maybe higher than 78. It's rolling over again. I wouldn't be surprised if we're back into low 60s very quickly, maybe even into the 50s again. So if you get that, it's going to pressure gasoline prices lower. The Fed's worrying about inflation. They should be worrying about deflation.
Two follow-ups. The first one, I pulled up the Fed Watch tool, which actually complements our conversation earlier well, because for those that are unfamiliar with the CME Group Fed Watch tool, it literally just uses bond futures to determine probabilities. And right now, the 30 July meeting is 95% implied probability of no change, 5% probability of an ease, and then 17 September is a 60% probability of an ease. So a little over half priced in right now in terms of an implied move. If we don't get a rate cut, let's say July, September, does that have an impact of your view of things?
No, because of what I said all along, earlier in the conversation about the bond market leading.
Mm.
I really don't think the Fed's in the driver's seat on rates. It's the bond market, and I'm much more enamored by that big top in rates and the fact that it's rolling over. I don't need the Fed. The Fed will come. I can tell you they're not going to fight it when that gap gets wide. They can't sit there stubbornly and say, "Yeah, but we don't know." The market will. They look at the market too, so the
Right.
market will pull them in terms of rate cuts. But I just don't know when. I mean, if I think the odds are high that they'll do it in September. But if they get stubborn and don't, it doesn't matter to my
Got it.
scenario because unless I'm wrong on bonds, and I don't think I'm wrong on bonds. So
Got it. The second follow-up question I had is we're going through earnings season right now. A lot of the banks already reported. I actually was looking through Wells Fargo's earning release. I like to use a couple of them just to get a health of stuff, see what it looks like. And the consumer looks more resilient than I was expecting to see. Is that part of the way you're conducting your analysis as well, just analyzing the health of the consumer? And if so, is there anything that sticks out to you at this point?
yeah, delinquencies are moving up. You are seeing the consumer. They're still out there, kind of trading off. When they want to take vacations, they back off on some of their bigger ticket purchases. When in the aggregate, when they want to accumulate something, cars or bigger ticket purchases, appliances or what have you, you see the travel back off. They seemingly have figured out that they can do one or the other, but they can't do both. Obviously, it's the top half of the income that's doing that. The bottom half is just trying to get by. And they are finding it harder and harder, and you're seeing it in the delinquencies and various areas. So and housing is rolling over, so you're seeing some signs of uh, you know the weakness there. But overall, yeah, consumers, it really, I view it right now as that gives me the confidence that I'm right, that people go, well, you're calling for a global bust next year, could start even by the end of this year. How can you talk about, and you're saying we could even be in recession or close to recession now? How can you say that and then out of the next statement be that you're calling for 8,700 on the S&P? They don't jive. And I said, yeah, they do, because my forecast is not a consensus forecast by any means. Most people don't, even the Fed doesn't have any clue that a bust is possible. They're not, no, nobody out there in mainstream economics is calling for a global bust, or at least nobody I know. And global bust is bigger than 2008-9. So I'm not saying I'll be right and everybody else is wrong. I'm just saying that's my forecast, but that's not consensus. And as you say, the consumer right now, looking at the data, is basically strong enough to convince Wall Street and convince all the strategists and economists soft landing, no recession in sight. So that's what I think you're going to have in this final leg to the top is rates coming down, inflation trending down, um, jobs still holding together, not big drops in the jobs picture, kind of beginning to fray at the edges, but not too bad, and apparently a soft landing, and that will give people the kind of um, the just right scenario where they can have their cake and eat it too. It's like it's not too hot, not too cold, and that's what stock market likes.
What's your take on AI? How does that impact just future valuations and potential future productivity of companies? I feel like that's probably a big implicit part of a built up forecast that you might have, not to put words in your mouth, but just imagine the bubble speculation component to that is probably real. But I don't know if that's a big part of what you're thinking, a trivial part. What do you think of AI in general, and how does it play into your forecast?
Well, certainly from an economic standpoint, I know you're talking more from the market standpoint, but from an economic standpoint, it has to be helping productivity. We're still in the early stages, so I don't know how much it's being implemented, but you are seeing it, in our everyday lives that AI is playing a role in phone answering,
Yep.
and certainly people in our industry are able to go to Chat GPT and get a lot of analysis done without having to do all the legwork they used to have to do. So, there's lots of applications. I'm sure in medicine there's some applications and elsewhere. Um, and marketing for sure. So I think it is helping productivity. Um, and that's a good thing in terms of kind of helping to hold inflation at bay. So from an economic standpoint, there's at least at the margin some positive. From a stock market standpoint, clearly the AI stocks have been leaders and will probably continue to be leaders into the top. So they certainly help, and people have asked me that, not too often, but um, you had the scenario before AI. How did you see it? And I didn't factor AI in. Obviously, I didn't know what was coming. Um, but if it hadn't been AI, it might have been something else. So, I was looking at it more from a big stock market picture, both technically and macro wise, and all the other stuff macro wise. So, but AI certainly has enhanced things, and it's why, I mean, my forecast, back in I guess 2022 was 6,000. I raised it in 23 to 7,000. I think I may have my dates wrong, but I think in January 23, I might have raised it 7,000, raised it 7,500 last year, and then I've gone this year from 75 to 8,000 and then to 8,700. So if you go back to my original numbers, AI wasn't at all there. So not that I'm factoring it in any mathematical way. Certainly, the fact that I'm extending my targets has a lot to do with AI. Certainly, I haven't thought of it that way, but certainly AI has been a big part of why the market's up as far as it is.
Yeah, it seems like a pretty profound disruptor no matter what. And I think the interesting part about it, I'm curious your take on the pricing of it. Do you think that the market is pricing it in effectively? Do you think it's overpricing what it might be able to do, underpricing what kind of impact it might have? Any thoughts on that?
Well, the only thing I'll say is I do think it's going to get hit hard in the bust. So it's not a straight line from here to when it really, AI's biggest impact is going to be next cycle, right? I mean, it's in its infancy. So we know that, post bust, that next cycle, AI is going to be front and center in terms of productivity enhancements and more adapting, more adoption of it in all kinds of places. So um, but even though that's the case, we're not straight lining it. We're not going to go from here to there without a big disruption. So if I'm calling for an 80% bear market and the biggest financial crisis in history next year, AI is not going to be able to skate through that. It'll get hit, and the stocks will get hit hard. So I don't really worry too much about trying to quantify anything beyond that because I know you got to get through that before you can look at the other side. Um, but for sure, I mean, I think AI is, like I said, it's had an impact this cycle. It's going to be a much bigger impact in the next recovery cycle.
Makes sense. And another question I had was around Bitcoin. Obviously, Bitcoin is really going through a bunch of different phases, but it's starting to grow more in terms of adoption and general acceptance, at least as far as we can see from like the big banks and stuff like that. In the beginning, they're super dismissive, whereas now we're starting to see some of them adding it to their balance sheet and trying to talk about processing with Bitcoin as a cryptocurrency. What do you think about cryptocurrency, Bitcoin in general? I know last few times we talked about it wasn't like a big part of what you were looking at. I'm curious if that's the same and how you fit that into your broader analysis.
Yeah, my approach hasn't changed, which is I want to see crypto go through a test in a bust. It's never been truly tested in a it's new this cycle, cycle from 2009 on. We didn't have crypto back then, so in the last whatever 6 7 years, whatever, we've been in an up cycle. I don't count 2022 as anything. It was a little disruption, but so my thing is I want to see it get through a very big downturn and see how it serves because everybody has their opinion. I'm skeptical of those opinions because most of those have occurred. I mean, I know how opinion is. I mean, being a contrarian, being a sentiment person, I know how much opinion is based on the momentum of the tape. And crypto has
Hmm.
certainly been a magic momentum investment. So all the the big names out there that are Saylor and all those guys that can talk with all kinds of confidence about what crypto is going to do in the next 10 years or whatever. We haven't been through a down cycle. Let's see it live up to its billing during a down cycle. Let's see what happens then. Um, because most of the talk is basically like talking NVIDIA. Those that have been in NVIDIA for the last 10 years can speak with all kinds of authority because they were dead right. They got in and it went to the moon. And so they have all kinds of confidence in it and they can speak with so-called authority on it. But it's mostly based on the performance of the stock. Same thing with, I mean, not that it's not a great company, but same thing with Bitcoin. I mean, it's, the fact that it's, run to 110 or above from way down, those that got in there look like geniuses. But let's see how the actual asset performs in a down cycle. then I might start following it and have an opinion on it. But up until, I've just chosen to sit it out this cycle, and people will call me an idiot or whatever on Twitter for it. And I'll go, it's got nothing to do with how I saw it as an investment. I just didn't feel it was tested, number one. And the thing I always say is, even today, it's getting more so a little bit, but even today, I can say it has very little macro significance. It has great significance to those who own it, but it has very little, in the scheme of things, macro significance at this point. So I don't need to follow it because I'm a macro strategist who's, that's what I follow, is things that are significant in macro. Um, but because there are those that think it's going to save the financial system and all that. It's not nearly at a point now where you can make that claim. It can save somebody. It can save those that are in it who are outside the system if all of a sudden, money in the banks is absconded and they're outside that. It can save them, but that doesn't save the system, right? So it doesn't have real significance yet. That's not to say it won't. Certainly, Trump's backing of crypto and stablecoin is making it more mainstream. I think at least it's more than just an investment now. It might be used in transferring money across, global line, across country lines, et cetera. So I'm not saying it won't progress to that point. I just haven't felt the need to follow it. And there's a lot of people out there who know a lot more about the technical side of the asset than I do. So I wasn't adding any value in that respect. And I just, from a macro perspective, didn't think it mattered.
Makes sense. A couple last questions for you. So far, how have metals and commodities behaved against your expectations for the year? Because we touched on the year so far, but we didn't touch too much on those.
Yeah, they are. I mean, gold's performing tremendously, and silver's coming along. If I had not um, done what I always do, which is go off on a tangent, when you asked about sectors, this would have been at the top of the list of another one to highlight because the precious metals are they they are ready to run. They've run and they're ready to do a lot more. So I think silver right now is at 39 or thereabouts. I think it can get to 44 in very short order. And from there, my target 75 could be there by the end of this year. Gold, my target's 4,000. I think in the next couple of weeks, you could see it up 200 or 300 points. I don't know that exactly, but I mean, they both look poised to break out here and run, break out further and run. The miners, which have lagged, are coming to life as well. So right now, there's not a group that I like more. I mean, they are really in great positions.
And do you think that there's any interplay between the run up in equities and the run up in gold occurring simultaneously? I know the correlate for those, a lot of people think that they're like inversely correlated, but the correlations are way more complex on that. And it also is super time frame dependent. So
Yeah,
I'm just curious how you think
you're
about
absolutely
that.
right. I get that all the time is people just assume
Right.
that they can't move together. And I've been consistently saying for a while now, certainly this year and probably last year, that they will move up together in the meltup. That and then they have. I mean, certainly there are times when they do deviate, and there's certainly times when it feels like the miners started to go and then they gave it back, and so it's been frustrating. But I do believe in this final stage, and even given the pullback that's coming, I wouldn't be surprised. This is again a scenario rather than a forecast, but I wouldn't be surprised if we get what I said before about a run up to say 6,500 on the S&P, and then a 6 or 7% pullback. I wouldn't be surprised if the gold and silver are running while that's pulling back. So at that point in time, they can go opposite. But I also expect gold and silver to run into, at the same time that the equity market's running up to its top. So, and one thing I've said to people when they were trying to, throw that inverse correlation, I said, and were kind of at me for saying that they were going to move together. I said, it, markets are funny. They stair step their way to a top. So I'm not saying that they could, one could be stepping up while the other's stepping back. But when you look at the overall, let's say 9 month run, they're both running together. They may not be precisely running together. One may be pulling back while the other one's running, and the other one then picks up speed while you take a pause. So I don't worry about that. All I know is that the equity market and the metals markets are both going a lot higher
Mm.
in the next several months.
Last question for you. We talked a lot about sentiment. What's something that you think people, and I put that in air quotes so it can be internalized to whatever that means to you? It could be traders, it could be just pundits, it could be analysts, whatever that means to you. What's something that people are getting wrong right now based on your analysis?
Well, the biggest one is probably the everybody's got one foot out the door and looking for a top. I mean, I think that, and it's a tricky one because, as I say, I think we are approaching a 43-year top. So normally I would be saying, yeah, I mean, um, actually, I think the Bank of America, Merrill Lynch strategist recently made a bear call. Said my signals are consistently right at these at tops, and they're giving me a sell signal now. And people said, well, they started assuming I wouldn't like him, and I said, no, he's probably, his work's probably a little longer term. We could be very close to a top months wise. We could be a few months from a top. The problem is the returns from here to that top are returns you would normally have to wait 2 and 3 or have to get over a 2 or 3 year time horizon. 40 or
Right.
50% returns, you don't get those in 3 months, you get those in 3 years. So, but that's a lifetime away or that's a long term distance away, price wise, but time wise, you're near the top. So there are a lot of signs that we've come 43 years, that naturally you're going to get a lot of topping signs that, you know, things are frothy or what have you. It's premature to call that top here. Um, so I think they are getting that wrong. They've been skeptical all the way up here. And, institutions don't go all in or all out unless they're a hedge fund. Hedge funds haven't been all that right, I don't think. But institutions in general doesn't mean they're out of stocks. They've participated, but they've been, a lot more cautious than they should have been. And I think they remain that way now. Um, they're getting it wrong there, and they're going to probably get it doubly wrong, um, because at the top, it's almost predictable. They're going to be the ones screaming buy, buy, buy. When I'm saying, nope, I'm exiting stage left. So they're getting that wrong. Probably the other big thing they're getting wrong is bonds. You know, there's so much bearishness around about interest rates. I mean, that's probably the biggest one, even more than what I just said. The vast majority of investors, both institutional and retail, are thinking rates are going up, not down. And I get that. I can certainly read that in my questions I get. Um, and again, a lot of it surrounds the Fed and, you know, why are you so sure the Fed's going to cut? And I said, I'm not. That's not even my concern. I'm sure the rates are going to go down. As I said to you, I think it's inflation's trending down. The Fed's worrying about inflation going up. So with the Fed worrying about that, so is Wall Street. So I think they're wrong on inflation. And not everybody. There's kind of a split camp out there on inflation, but they're wrong on interest rates. They're too worried about the rise in rates when I think they should be recognizing that the real story looking forward looking out over the next year, not over the next 3 months, the real story is deflation, much lower rates, much lower dollar, and ultimately a global bust. But the global bust part won't be on the horizon for a while.
Beautifully summarized. And we will, as you know, follow up and we'll see how everything pans out. As always, awesome hanging out. I appreciate you sharing your wisdom and just spending some time. I know folks can get a hold of you on X. I can make sure that I include the correct profile for you in the description. Anywhere else or anything else you want to let or direct people to?
Yeah, just I do my quarterly letter, which they come out second week of the new quarter each quarter. So, my last one was middle of July. Um, that is by subscription, so it comes with a cost. It's not for everybody, but it has. I have a lot of retail investors. It used to be an institutional letter, and then I started realizing that I speak plainly enough that it was valuable to retail too. So the last 4 or 5 years, it's been offered to retail, and I think I have more than 2/3 repeat subscribers, meaning, I think in the subscription business, if you hold on to 20 or 25%, you're doing good. And I hold on to generally 60 to 70%, I think, of my subscribers. So, they must feel it's valuable in some way. Because I tell people if you're a little investor and the cost is too much for you, I put out enough on X and in these kind of
Sure.
interviews that you can at least get a sense of my view. Obviously in a letter I can be a little more detailed on my rationales, et cetera. But I've got enough people that follow me on X, follow all my, watch all my interviews, and they still resubscribe and say, no, I really get helped by it. So, and then other people go, I get enough for free. Why do I have to pay for it? So it's up to people to kind of
Yeah.
decide that for themselves.
Cool. And anything else that's top of mind for you, or are you otherwise all set?
Um, yeah, I think, like I said, I think you got, somewhere in the next few weeks, probably a pullback. But after
Okay.
that, I would get on board and let this thing run because I think it's going to be the biggest rally in history in terms of the amount of distance covered in the shortest amount of time. I think it's going to be a steep, one of those wow, where did that come from type of things. But don't get wedded to it. Uh,
Hmm.
and it doesn't hurt to be early. It does hurt to be late. So I'm not telling people get in and just kind of wing it, but um, be careful. My last piece probably is just be careful. There's a lot of opinion out there. Don't let it kind of steer you wrong because it's easy to have that happen too.
Information overload is real. So it's a good point. Awesome, David. Well, thanks for hanging out. As always, everybody, you'll be able to check back in about 3-4 months or so, and we'll have a follow up, and we'll touch base and see how everything's going. So thanks for hanging out, David.
Yeah, thanks, Eric. Have a good summer.